and we had about 68 slides. So that's
I mean, don't worry. I told him to cut it to shorter. Don't worry, Nelson. You're
Move
good.
quick. Move quick.
you did
Yeah.
a great job cutting it shorter. So you will be impressed. We reduced our slides without discounting the viewers and your members from 68 slides to 41 slides. So I have about a little under a minute per slide. So I've made it happen maybe once. So I'm going to try to make it happen again.
Yeah,
Fantastic.
that's awesome. Especially because yesterday we had a chat too, and I'm like, oh, but I want to learn about this. Oh, wait, we could do that. I want to learn about that. And then it just got longer. We were supposed to shorten it, and I kept adding on to it.
Yeah, any incredible questions. So for some of the viewers that are here today, if you have no questions, Annie bombarded me like 30 questions. I felt like I was getting interviewed. And then later on, I asked Annie, what do you do for a living? She's like, interview and recruiting. So excellent spot.
I was like, totally non-related, but this is way more interesting to me.
Fantastic. Great questions, by the way. So we went from 68 with Annie's feedback and some of the questions. We went up to 120. And we just destroyed about 80 of the slides. And now we're down into the 40s.
We'll do like a marathon version.
Great. I just did a presentation in front of a little over 500 people live in Los Angeles. So this is definitely refreshing, being in the comfort of my home office.
Do you work? Is that your house then?
Oh, yes, I'm currently in my home office. So if you hear 3 kids crying in the background, it's normal in our household. I have 3 kids under 5 years old.
Damn, that bookcase.
I know. I thought it was like a law office in the back.
Oh,
Legit background too.
yeah, it's a real background. So that's actually I read pretty much the majority, if not all, those books. But that's already, I would say, probably close to 400 books. But if I were to fill in all the bookcase, my wife saw some of my books and she threw it away. So she just wanted it to be a little bit cleaner.
Man, and I forgot today was actually right now at this moment we have our SARE New York City meetup, and I was like, oh man, I planned on the wrong date, dude, because they would have been perfect to come and meet you too.
Oh, wow.
It's true. Yeah.
Yes.
We have a chapter in New York City.
Usually about 40, 50 people show up.
Yeah.
It's a pretty big group over there. But we're going
If you see a
monthly meeting.
Yeah. Kevin runs our other biggest meetup. We always get 40, 50 people in SoCal once a month.
Oh, he's in here today. Hey, Kevin.
So my goal in this presentation is really low for you to not lose any members. No members. Presentation.
Yeah, we're gonna start in about 2 minutes. We start 5 minutes on the hour, so
Sure, awesome.
That gives time for people to keep feeding in. We're gonna expect probably around 50 something, 60 something people for this one.
Great. That's really good attendance for this hour of the day. So awesome.
It's the best time of night because a lot of people still work. So
really, wow.
Yeah.
Okay. Especially, I'm assuming for the West Coast, it's like 5 p.m. East Coast, 8 p.m. Depending on our roles and occupation, right? Some people are still working. I understand.
Yeah, I feel like they're making this perfect for the work from home people, usually the higher wage earners, and they can just entertain themselves at the evening, those last hour. So they're good. Yeah, so I see a lot of Bay Area folks in here, so I'm going to make a quick announcement before we start. We have our Invest Now conference this Saturday in South San Francisco from 9 to 2 p.m. This is in collaborations with Sequoia Real Estate, and I believe we have almost about 300 people who are expected to come out, so this is pretty awesome, pretty big. We've gotten a couple donations for free tickets from our sponsors, such as Fractional and U.S. Bank and Asset Preservation. So I do still have about maybe 5 tickets left if anyone wants to come. Then after 2 o'clock, we'll give you some time to mingle, meet with the speakers and talk. And then we're going to move everyone over to Hung To's Seafood Restaurant so that we can entertain, hang out for Mid-Moon Festival and meet the agents. So if you guys want a free ticket, don't PM me. PM my friend Danny. He still has maybe about 5 more tickets over there. So Danny Wong is in there. But hope to see you guys out in San Francisco this weekend. So that's Danny from Fractional. Alrighty. Yay. Yes, Class President Wong, Danny Wong. So that's a nickname that we give Danny because he's been super helpful to all of our friends in the group. So we call him our class president. All right, it's 5:05. Nelson, you start.
All right. I mean, it's 7:05 here, but either way, thank you all for coming tonight. We're going to talk about something a little bit unique. It's a investment methodology that I use. So if you guys haven't heard of it before, it's called infinite banking, as some people might know it. Personally, I think it's a terrible investment vehicle by itself, but it's an amazing savings bank, like probably one of the best ones that you can get out there. I first clued in on this once I joined this mastermind, and I met a couple of really high net worth individuals and their families, and they said they used, this like life insurance policy for investing. And I was just curious about why people did it, what benefits it had versus, because, the way I was always explained and the way I read it was just that you have to pay so much to like in premiums that you kind of lose out the benefit of the investment. But then I had to repivot my way from thinking of it as an investment vehicle to just being like a savings bank, which it absolutely is crushing at. That being said, I wanted to give a quick introduction to Rick Hu. He's the agent who helped me set up with mine. He's a wealth manager and president of Midas Wealth. He helps clients with all aspects of their investing, personal financing, especially when it comes to directing financial strategies for client portfolios. Before finding Midas Wealth, he was a managing director for Northwestern Mutual's Chinatown office, which he started when he was just 25. So he's one of the #1 district offices. Now it's, by the time it was in the 5th year of operation. So aside from that, Rick, has been featured in Forbes, Winston Benefits, Yahoo Finance, Newsday, and he's got kids. So without further ado, I'm going to let him take it off and tell us about his specialty. So.
Thank you, Neslin. Thank you for that kind introduction. So just want to thumbs up. You guys can hear and see me okay? Perfect. So I know today, thank you guys for all having me here. I've done this presentation quite a large amount of times. So hopefully I'm here to really educate you all. But full disclosure, as we all do, because this is being recorded on Facebook Live as well, none of the information I'm sharing in my presentation is a recommendation or advice to you. I am licensed in many different areas of finance. So full disclosure, this is not financial advice. It's not any specific recommendation. This is just for educational purposes only. If you would like tax advice, wealth management advice, or even legal advice, it's always best to seek your professional. So I'm going to dive right in. As we were starting earlier, I shared with Annie and Nelson that we as a team prepared a slide for you all today. So are you able to see the screen?
Yep.
So I'm going to try my best to change this to slideshow mode. And please feel free to ask me any question in the box. I kid you not, I've never heard a question that was a bad question. You guys can ask me anything and everything you would like. And I'm extremely comfortable to share with you anything that you would like to ask about me. For example, I've had people ask me questions like, what's your blood type? I'm not sure why it matters, but my blood type is B positive, and I'm not trying to be motivational while speaking today. So this presentation slide, there are 41 slides. For my knowledge, we have 30 minutes of presentation time and about 30 minutes of Q&A. I'll try my best to stay on time. But my major focus and goal today is to educate you all, to provide value. Time is priceless. And for all of you to be here today, I really want you to just really learn, and feel free to ask me anything. So the presentation slide, when Nelson and Annie asked me to speak, they said, hey, I've heard of this concept called using life insurance for real estate, or infinite banking concept. So that's the presentation that we prepared for you all. So just a little background. I always want to share this because some of you might say, well, Rick, I've heard of this on TikTok, Instagram, YouTube. I've heard this from my friend, my cousin's friend, my cat's dog's friend, and that's absolutely okay. But I'll give you a little bio of who I am, what we do. So my name is Rick Hu. I'm a wealth management advisor, international speaker, author, business coach, and founder and CEO of Midas Wealth. So I've been in financial planning for 15 plus years, 7 of which those years, I was a managing director for a Fortune 500 company. At 25 years old, as Nelson mentioned, I was the youngest appointed managing director in the country at that time. And within 5 years, I built an office in Chinatown, New York, became the #1 office in the country. And about 4 years ago, my wife and I decided to start a family, and I changed my role and went back to private wealth. So as a private wealth management advisor, just some of the speaking engagements that I've spoken is university, colleges, hospitals. Recently, I spoke at Harvard Medicine. I speak on national radio stations. You may have heard me speak. If you YouTube my name, you may have heard me speak in the past. But feel free to ask me anything and everything you want at the end. So at Midas Wealth, we are a team of 10. This is just a slide of some of our senior leadership, where we have our own in-house CFAs, CFP, MBAs, and where we specialize working with professionals, families, and business owners that are high net worth, ultra high net worth, on concepts behind savings, investments, retirement planning, and creative ways of minimizing taxes. So I'm an expert in insurance, investments, wealth management, retirement, and tax strategies and other planning aspects. So this is just a few of our team members. Whenever we create a customized plans for our clients, our goal is to create an actionable, realistic plan that gives you clarity and confidence for your financial future, customized to your goals and needs. As Nelson mentioned, what we're proud to share is in 2022, recently, as of 2 months ago, Forbes magazine did a survey that the methodology by Forbes and Shook is chosen based on algorithm. They interviewed over 33,000 financial professionals that included banks, insurance companies, broker dealers, other financial service firms. And out of the 33,000, 15,000 were interviewed over the phone or live. Amongst the 15,000, they wanted to find the top 100 financial professionals in the country. And we're proud to say we're in the top 100 in the country, and we're ranked top 10 in New York. But the criteria that they did was qualitative and quantitative criteria, including in-person interviews, industry experience, compliance records, revenue produced, and assets under management. If any of you want to, so I would love to see my team were here. That would have been great. So I'm really good at finance, really good at math. I'm just not really good with these PowerPoint slides. I used to do these when I was in college, but I don't even know how to share this. Nelson, do you know how to share this link that my team was kind of to add?
Press Control click.
Yeah.
Control?
Oh yeah, you could like Control click it, and then that should open it.
Oh,
Or Command click.
Open it. What I was wanted to do is I was just going to share in the chat box. So for any of them to read on your own.
Yeah. If you look at the bottom, there's a chat functionality, and then if you copy the link and then scroll to the bottom, chat should appear. It's like a button on the.
For some reason, it won't allow me to copy.
Okay, we'll just add it later. If you can upload your slides, people can take a look at it later.
Absolutely. So this is just a little bit about the background. And then when it comes to wealth management, there's so many areas and moving pieces. So there are 6 areas of financial planning. If some of you can see on the screen: financial position, cash management, debt management, network analysis. We do protection planning, insurance coverages, additional coverages. So what we also do for some of our clients is analyze their benefits. As open enrollment is right around the corner, we help them understand which benefits are necessary and which may not. We help clients with investment planning, risk tolerance. Additional consideration is other RSU stock options, especially with people that have companies with stock options, tax planning, tax efficiency, retirement planning, 401ks, profit sharing plans, retirement phases, and estate planning. But I'm really excited today to share with all of you in the evening time, because today's agenda is about life insurance. So I'm sure all of you have notes ready, and feel free to ask me anything. So today's agenda: how to utilize cash value whole life insurance to create leveraging opportunities. The design and optimization of these specialized insurance instruments. We're going to be talking about methods of borrowing against your own cash value whole life policy, interest rates and how it impacts these policies, and time frame to access funds, which is very important, especially it's called subtle Asian real estate. Many of your peers are using this for many reasons, including real estate investing. So the benefits of the infinite banking concept. So the overall idea is about using the cash value whole life policy that pays dividends to become your own bank. That's just kind of like instead of paying interest to creditors for loans, you can borrow against your own whole life insurance policy and then pay yourself back the loan and interest. The benefits of this method includes policy receives annual dividend payments. Number two, guaranteed accumulated value growth in your policy value. So what that simply means, it cannot go backwards. It cannot decrease. For example, right now, the market S&P is down over double-digit percentage. Cash value whole life can only go up year after year. The proceeds, the tax-deferred growth on the account values. So what's very important about this compared to some other accounts, any interest or dividends earned in cash value whole life, it grows tax deferred. So you will never receive a 1099. An example, as Nelson mentioned, comparing this to putting money in like your bank account, as we may all know, there are really three areas of taxation. Number one, in my humble opinion, is the worst way is income taxes. So if I had, for simple math, $100,000 in my bank account, and I earned 1% in interest and savings, because interest and dividends earned is considered short-term capital gains, I will actually receive a 1099 from the bank for that 1,000 interest earned, and I add it to my ordinary income. So which is why we talk about long-term capital gains. So if, for example, in the same scenario, you invest 100,000, coincidentally, you invested in Apple stock, and ironically, you earned 1%. That 1% in Apple stock, if you sell it within 1 year, that $1,000, you pay short-term capital gains income tax. If you sell it after 1 year, you will pay long-term capital gains. And depending on your tax bracket, it's either 15% or 20%, which is always cheaper than income tax. So that's really two. So the first way is income taxation. The second way is short-term or long-term capital gains. But this grows, these products and instruments grow tax deferred, similar to your IRAs, similar to your 401ks, where you and I will never receive a 1099. So the interest is compounded over time. Number four, income is tax-free withdrawals. So as you withdraw the funds from this account, it's income tax-free. Loans avoids administrative or closing costs. So like possibly a HELOC, where most banks and institutions have no administrative or closing costs, these products, if they're designed well, and if you are knowledgeable about it, there are no administrative or closing costs when you borrow against it. And finally, generally provides a tax-free death benefit to your beneficiary. Now, pros of using life insurance for leverage. Here's just a link, and I wish I could click on this because, give me 1 second if you don't mind me, just quickly. I'm going to change this, and we actually prepared for, in the event there's some hiccups in our presentation. So I know this is being recorded, but if you get to know me on a personal level, I do believe that there's no such thing as perfection, but I strive for excellence and as close as possible.
I got it.
So you got it?
Yeah.
Perfect. So what I'm going to do is I'm going to change this to a PDF format. So I had a backup of PDF anyway. So are you guys able to see the screen?
Yep, looks good.
Fantastic. So with the PDF format, I'm just going to zoom out a little bit, and I'm here it works. So here's the pros of using life insurance for leverage. Actually, for example, I want to give you first, as I promised you all, I'll click on this link first, if it works. First and foremost, everything I share with you, there are sources, because I'm a big believer of reading and learning about this. Okay, so this is for all of you. Number two, what I also want to do is go back to our slide. As you may see. So benefits of infinite banking concept, pros of using life insurance for leverage. So for individuals who believe income tax rates will be higher in the future than they are now, this is a major benefit. So as your income taxes grow, especially in the highest tax bracket, this growing tax deferred is a very favorable advantage to you. Life insurance for substantial protection from lawsuits from creditors depending on state. So this is avoids protection from lawsuits and creditors depending on your state. For individuals who want to save money for college and preserve children's eligibility for financial aid under the federal method of calculating a family's expected contribution. So what's interesting is this is a good vehicle for you to set aside for children's education as well, and this does not impact your eligibility towards financial aid. Diversification of a portfolio for individuals who want moderate and guaranteed growth. What you'll notice is we're not talking about aggressive growth. Aggressive type of vehicles, you may include those as, for example, stocks, real estate, or even like cryptocurrency and other vehicles. But this is moderate and guaranteed growth. Has the similar features of a Roth IRA where individuals can contribute large amounts of contributions where there are no contribution limits. So like an IRA, depending on your age, under the age of 50, you can contribute 6,000, over 50 with the $1,000 catch up is 7,000. Your 401ks or 403bs is 20,500. With these vehicles, there are no contribution limits. Next, do not have to wait until 59 and a half years of age to access money. So there are no liquidity limitations like an IRA where you have to wait till 59 and a half to avoid the 10% tax penalty. Assets and policy bypass probate at death, which is really important. So if you don't have a will, a living trust, or other legal estate planning vehicles, the benefits through life insurance always pass through probate because of the beneficiary feature. And finally, for individuals who may expect to have an estate tax liability, this is a good vehicle using the death benefit to pay for future estate taxes. Now, this is just the pros, and I'm extremely obsessive about transparency, which is why I like to also share with you some of the links that we prepared. So this is interesting. So back to the slide, forgive me, technical difficulties. Here we are. So sources of infinite banking concept. So I'm going to try my best. See, it doesn't work. If my team was here tonight, we would be able to do it. But I will share these links with you so you guys can all do your own research and reading. So many of these you can read about to understand more about the strategy. But the one link which I want to click on is from NerdWallet when it comes to using life insurance as a source of liquidity. So as you can see here, I like to read it to you. Here's the pitch in a nutshell. Over the course of our lives, most people say oodles of interest to creditors on a manner of loans, from mortgages to cars to credit cards to college loans. This lost interest and the interest on that interest represents a tremendous strain on individual wealth. If instead you aggressively save money within a certain type of life insurance policy, you could fund these purchases from that policy and pay the policy back rather than the bank. While there are some technical issues with the phrasing, this is the functional equivalent of paying yourself for the loan with interest. So I'm not sure if many of your audience have heard of borrowing against your 401k. As you may know, when you borrow against your 401k, you have 100,000 in your 401k. The limit to borrow against it is generally 50,000 or 50%, whichever is less. If I have 100,000 in my 401k, I borrow 50. How much is it still in my 401k? 100,000. Because you're not borrowing directly from your 401k, the institution is collateralizing your 401k to lend it to you. And then there's a payback period. But the interest you pay into your 401k goes back into the interest earned into your 401k, and that's a very similar strategy. Thus, you are retaining the interest within the cash value of your own life insurance policy rather than paying off the bank. The claim is that rather than enriching the bank, your payments go back to enriching yourself or your heirs when the policy pays off at your death. Now, these are just some ideas. So is it a scam? No, certainly not for everybody. And that is absolutely true, which is why this is just general educational purposes. I don't know any of your members. And if you share this with your group, I'm not saying that everyone should do this. In fact, many people are not suitable for this type of concept. There's only a small group of people that we generally recommend it to, depending on their overall financial profile. So it's not certainly for everybody. There's a number of factors that have to be in place for the concept to work well, but it is not a ripoff or scam by a long shot when properly set up. So you could read about the historic idea, why it works, the two concepts, but I want to talk about the pros and cons, the downside. And I want all of you to remember the downside. To me, it's really important. And I'm going to add this link, if I haven't already, add it to the group chat so you can click on it and read it on your own. But the downside, it's not for people who don't need or want a permanent death benefit. In fact, that's absolutely true. If you don't need life insurance, this may or may not be right for you. But however, if you're using this for life insurance purpose, then you wouldn't design this type of policy the way I'll show you in a little bit. Number two, it's not for people who can't afford a term premium to protect their families. Absolutely correct. Because when you're doing cash value whole life and the way we customize it, the premium is definitely more expensive or it takes more contributions than term insurance. Therefore, if you can't afford term insurance, forget about it. This is not right for you. Number three, expenses are front loaded. The agent and insurance company can eat up half of the first year's premium. Now that's controversial. And I want to prove that to you when you look at my presentation a little bit. Number four, it's not for people with an unstable source of income. Absolutely. If you have an unstable source of income, you're not suitable for many of these areas. So generally, this product or it's a strategy, in my humble professional opinion, is just really suitable for certain types of clients. And we generally work with accredited investors. Those are the type of clients that we generally recommend it to. So, and then when such a strategy may be important, people believe the income tax, and that's kind of like part of the slide that we just went over briefly. Okay, so I went over this. So let me just go back to the slide. The next slide, I'm going to pretty much go over, close the chat box. We're going to go into straight how these policies are designed. So cash value whole life, 100 paid up at age 65. So in order for you to really understand how these policies work, and if you go online, YouTube, TikTok, Instagram, do your own Google research, which I always encourage is about empowerment and education, you're going to read so many different opinions. Now, I humbly believe 30 years ago, when I was younger, right, information was hard to gather because there was no internet. Today, the problem is the opposite. Today, it's really easy to gather information at the palm of our fingertips with internet. But the problem is it's very difficult. It's very difficult for us to decipher what's good information, what's bad information, and what's accurate is what's inaccurate. So I want to first share with you how cash value whole life, traditional whole life insurance will not work for all of you. So you might read online where, hey, this concept, this strategy doesn't work. And it's true if you buy regular traditional whole life insurance. So this is regular traditional whole life insurance. So I'm just using this as an example for some of you to see here. And I hope you can see. And I'm going to take a pen to kind of draw so you can all see what I'm talking about. So this is $1 million permanent life insurance that's payable to age 100. And this is traditional cash value whole life insurance. Once again, it will not work with what you're looking to achieve. This is not the infinite banking concept by the book R. Nelson Nash. But what I want to share, this is just as an example, a 30-year-old male, non-tobacco premier. To do this, it's about $15,000 a year. But there are 6 benefits that are illustrated on these policies for all of you to understand. The 3 guarantees. Premiums are guaranteed. So if you get your age locked in at 30 years old, it doesn't matter if you're 40, 50, 60, your rates can never increase. And why is that important? Many times when I meet someone, they don't need life insurance, but they just want life insurance. The reason is life insurance is priced in 3 categories: age, health, and gender. Let's say gender is the same. Health, let's say you're perfectly healthy today and you will be healthy 5 years from now. Finally, it's age. On average, as you wait, when you apply for these products, on average, each and every year you wait, it may cost 3, 5, or 10% more, depending on your age group. So once you lock it in, your premiums are locked in. Number 2, your death benefit is guaranteed to grow. And number 3, you have guaranteed accumulated value, which is column 6. This accumulated value will grow over time. Next, it provides coverage for life as long as you pay premium. So this policy will not lapse compared to other products like term insurance and other variable products out there. Number 3, it provides a tax-free death benefit to your beneficiary. So God forbid if I pass away yesterday, my spouse will receive this income tax-free. Now, here are the other 3 categories which makes these products efficient. Number 1, provides tax-deferred accumulated value growth, compounding, no 1099s, doesn't drag onto your income tax rate, which is awesome. Number 2, annual dividends can be used to increase your death benefit and accumulated value. So over time, your dividend is going to grow. And number 3, accumulated values, and this is the single most important definition, can be accessed at any age, any reason, penalty, and often tax-free. And I'll show you. But once again, this is not the type of product we would design for any of you. So column 1 is the death benefit. You'll notice the death benefit grows over time. Column 2 is the dividend. It grows over time. Column 3 is your premium. Once you're locked in, for this example, a 30-year-old male, it's always going to be the same. That's great. You're getting more death benefit. You're getting more annual compounded dividend, but you never pay a penny more. And how dividends work, it has a direct and indirect relationship with premium. When the dividend is higher than the premium, you can use the dividend to pay the premium and the policy can be paid up, like a mortgage. When the dividend is not higher than the premium, dividends is given at the beginning of the year. Throughout the year, you're going to get something called increase in accumulated value. And this increase in accumulated value gets added to your total accumulated value, which is column 6. So you'll notice year 1, there are no dividends. Once again, I'm not recommending this in the infinite banking concept. You're putting 14,000 because you get no dividends, your cumulative value is none, and look, you get none. Year two, $1,000, you're putting 14,000, gets reinvested, the 1,000 plus previous year 0 is 1,000. Year three, 1,400, you put 14,000, you'll see you get back 11,000. 11,000 plus the previous 1,000 is 12,000. Year four, 14,000, you get back 13,000. Year five, 14,000, 14,000, and year six, 14,000 and 15,000. So based on this traditional cash value whole life policy, you will notice in year six, every dollar you put in, your accumulated value grows more than that. That's arbitrage. That means for the dollars you put in versus what you receive back, you will notice the year before you have 41,000, you put 15 plus 41, it's 56,000. What does that tell me? That means the first 5 years, you're paying for something called, in our world, IAC, insurance acquisition cost of insuring your family. Now, we have clients all the time ask us, Rick, can I start making money year one? The answer is logically, simply, no. And there's a reason for that. An insurance company are like banks, they're for-profit company. Imagine the first year you gave an insurance company $14,800, and at the end of the year, they gave you back $15,500. So therefore you profited. And if God forbid something happens, they gave your family $1 million, and there'll be no more life insurance company in America. How can they afford to pay the death claim and give you a profit? So what's generally happening is, in this example, the first 5-6 years, the insurance company is taking the delta between what you're paying them in premium and what they're giving you back in accumulated value. They're investing it. So if we, God forbid, happens to pass away prematurely, they can afford to pay the death claim. So you'll notice the first 5 years, whatever you put in, you get less back. Then you put in 14, you get back 16, 14, 17. And then you'll notice after here, year 13, you start profiting. So first 6 years, wherever you put in, you get less back. The next 6 years, wherever you put in, you get more back. So in year 13, your total contribution is 193,000. Your total accumulated value is 197,000. So this is in Nelson's case. Nelson said, Rick, I don't need this anymore. Let's cancel it. He'll get all his money back. And he showed a profit. And the last 13 years of protecting his family was essentially free because he profited. But it gets even better. You'll notice because after year 6, every dollar you put in, get more back, you will notice the cash value just accumulates. In year 20, he would have put in 287,000. He gets back 398,000. He would have made over 100,000 and continuous. But if we keep these policies until age 65, and you'll notice by 65 years old, the dividend's enough to fund the premium. So what our team did was we changed this policy to be a paid-up policy at the end of year 35, because at 65, most people, if they're retired and they're collecting Social Security and Medicare, they're probably not looking forward to paying 14,000. Well, you'll notice at 65, the insurance benefits started at $1 million grew to 1.8. The dividend is 35,000. It's enough to cover the 14. This example, this person put in a total of 520,000, and there's 1 million. So now they have 3 options. Option 1, Rick, I don't really need this life insurance anymore. Great, then they can cancel. They put in 520,000. They can withdraw the 1,090,000, and because the money they put in, it's after tax dollars, they have an opportunity to withdraw that income tax free. That's option 1. Option 2, they don't need the 1,090,000. Essentially, they're really successful. They say, Rick, I just want to leave this as a legacy. What they can do is they put in 500,000, their death benefit is 1.8 million. This is almost 3.5 times what they put away, and they could put into a trust and leave it for their children and grandchildren, passing through probate, and the death benefit generally goes to their estate tax-free. Or the third option, they say, Rick, I don't really need $1 million of cash value. And I know that if I take it, I'll cancel my policy. Or I don't really need the 1.845 million to grow because I don't want to spoil my kids. The more I give them, the less they work. I've heard that before as well. What they can do is they can actually have this policy stay at the accumulated value, have the death benefit not grow. They can date distribution of the dividend, because at that point, they can start taking 33,000, 35,000, 37,000 as a form of an income stream for the rest of their life. Now, this is the traditional way of cash value whole life, which is not efficient for all of you. And people always ask me, although this looks great, what are the pros and cons? Now, the reason why I would never recommend this for infinite banking concept, and most insurance agents or financial advisors recommend it this way, is because if you think about this, you don't actually break even until year 13. There's no arbitrage until year 6. Now, oftentimes clients ask me, they say, well, Rick, I noticed I'm not making any profit But this design is very similar to like real estate. As many of you know, when you're doing a 30-year fixed mortgage, the first 10 years, you're not really paying mostly principal towards your mortgage payment, it's mostly interest. In year 10 to 20, there's going to be a crossover period. And in the last 10 years, that's when you're hitting more principal than interest when you're paying off your mortgage. So essentially, it's structured a really similar way where the first 10, 12, 13 years, you're not going to see much profitability if you structure this as a traditional cash value whole life. But you'll see, excuse me, overall, once you get to these policies, you can actually even also do an annual income where you annuitize this policy at age 65. So for example, if you and I at 30 years old put 14,000 a year all the way to age 65, and at 65, we said, hey, I want to annuitize and I get 67,000 a year, which is approximately 4 times more than I put away. Would that be okay? So this is also another stream of an annual retirement income. But once again, this is not the infinite banking concept, which is why these policies get such bad raps, because there's a lot of insurance agents or financial advisors do not know how to design them the right way. And this way will not work with what you're trying to achieve. Now that you understand how regular traditional cash value whole life works, I'm going to teach you how to build or how to identify an infinite banking insurance policy. So when you're designing these policies, it's very important designing these overfunded life insurance to create the leanest possible cash value whole life policy to reduce the cost of insurance. It includes a blended term insurance to increase the death benefit and funding capacity. Additional contributions into the cash value portion of the policy. The design policy, it offers flexible minimum premium that's mainly within your budget. And this policy offers paid up options, which allows you to reduce or stop premium overall contributions at any specific goal date or age. Now, one thing you need to understand, the cumulative value grows from policy premium, like the first example, additional overfunding, which I'll show you in a little bit, and the annual dividends. But be very careful. If you work with an insurance agent or financial advisor that does not know how to design this and to design this incorrectly, you have to avoid the creation of creating a modified endowment contract, which is a MEC. Now, what does overfunded cash value whole life insurance infinite banking concept look like? So if you recalled earlier in my previous slide, the break even was around year 6, where you see arbitrage. The total break even is year 13. This is what Nelson was referring to earlier. This is also a $1 million permanent life insurance policy, but you'll notice something different. What's different is the base is no longer $1 million. We actually made this the leanest at 50,000. So therefore, the core cash value whole life is only 50,000. We added a 950,000 blended term component. This 950,000 allows this policy to still be a $1 million policy. Now, how this works, this is not regular term insurance. Over the years, this blended term gets converted automatically to the base. So the first year is 50,000, 950. The second year is maybe 100,000 and 900,000. And then one day, when it's all converted over to the base side, it will actually become 1 million and 0. And then you know what will happen? Your death benefit will grow. But because we designed this where the regular base whole life is such a low percentage and the blended term is 950,000, this is one of the lowest cost cash value whole life you can buy. Now you might say, well, what is the premium? It's 54,000. I know what you're thinking. Like, Rick, what are you talking about? The earlier slide, you were showing us $1 million that was 14,000 a year. You're showing this annual premium of 54,000 a year. This is more expensive. And I would argue the answer is no. And I'll prove it to you. As you may notice here, as I zoom in, although this says 53,758, we purposely gave this number because we included a 50,000 reoccurring additional premium. That means you're choosing to overfund an additional 50,000. Now, if you take the 53,000 minus the 50, that means 3,758.95 is your real cost of insurance. Which, compared to the early example of $1 million, which was 14,000 a year, this one, the real cost of insurance is only 3,700. This one is less. Now, when we designed it this way, you'll notice the definitions change. Policy can be designed to fit within your budget. So do you remember in Investopedia, one of the arguments was saying, hey, these policies, it may lapse, you can't afford it. What do you mean? As long as you design it the right way, they should fit within your budget. Provides coverage for life, provides a tax-free death benefit to your beneficiary. Now, once again, provides tax-deferred growth. Now, the annual dividends are used to increase your death benefit once all the term has been replaced, the conversion feature automatically within the policy and the accumulated value. But finally, the accumulated value can be accessed at any age for any reason, often tax-free. That's the most important part for all of you if you're going to use this as leverage. So now, as you probably remember, I want to show you the first year, the death benefit is not going to grow because we made this policy 50,000 base, 950,000 term. The death benefit initially hasn't transferred or been replaced over, but the dividend is much higher. Look, your premium, although 53,000, I want all of you to notice this. What are you getting in accumulated value? 48,000. This goes to column 6. Year 2, you put 53,000, you get 51. Year 3, you get 53, you get 54. Arbitrage. So the first 2 years, you and I are paying for IAC, insurance acquisition cost. So my question to all of you, and if you think about this, for some of you and most normal people, they think term insurance is very inexpensive. But if you think about the first year, 53 versus 48, that's what, 5,000? 53 versus 51, that's 2,000. And then it's pure profit. Can you get $1 million of death benefit through term insurance, let's just say for the next 30 years? That means each year it's on average costing you around $250. I don't think so. So what I want to share with you is the first 2 years you're paying for insurance acquisition costs. Then you put 53, 54, and to prove it, the year before you have 100,000, you put 53, you get 54, now it's 155, 53, 57. And then starting the first 2 years, what are you putting? You get less back. The next 2 years, what are you putting? You get more back. Look at your total break even in year 5, not year 13. This is how you design the leanest cost of cash value whole life insurance, overfunding it, not to benefit the insurance company, but to benefit many of you, right? So you'll notice starting year 5, you could say, Nelson says, Rick, I don't need this anymore, cash out. He gets all his money back and profited. And those last 4 years, the way the cost of insurance was essentially free because he received more than he put in. But you'll notice over the years, if he keeps this to 65 in this same scenario, you will notice his million grew to 6.2 million. He's put in a total of 1.8, he gets back 4.3. Now he's earning over 2.5 times. But I do want to mention, this is not a real policy. Rick, what are you talking about? How come this is not real? Because you'll notice there's a little orange highlight that comes here. Modified endowment contract as a policy year 9. The reason why these policies are so difficult to customize is because if you overfund too much money, it becomes a MEC. For many of you, I'll give you a slide and a link later. Google MEC life insurance. You do not want to put so much money into life insurance where it becomes a MEC. If it MECs the policy, then many of the tax advantages that you normally receive will be gone. So in general, clients then ask me, well, Rick, why did you design this so that it MECs? I designed this as an example to show all of you that I designed this in the leanest way, in the most cost-efficient way, and we're overfunding it almost to the maximum ability where it MECs in year 9. So now you may wonder, well, Rick, how do we avoid a MEC? And I'll show you simply. Just to kind of educate you on modifying endowment contracts, unfortunately, there are many insurance agents, financial advisors that attempt to do these policies and they do it incorrectly or they're not servicing it correctly because these are highly sensitive to dividends. If dividends go up, generally, these policies can MEC sooner than 9 years in that perfect example. If dividends go down, then it may continue to withstand the ability to MEC at that period. So these policies need to be serviced, and you as your client, and you need to work with the insurance agent, financial advisor to do due diligence every year to look at the policy to stress test the MEC test. So modifying endowment contract is the term given to a life insurance policy whose funding exceeded federal tax law limits. These limits on the amount of cash value inside a policy are placed to avoid abusing tax advantages inherent to permanent life insurance. So the IRS do not want you to abuse tax advantages on life insurance. The policy must fail to meet the Technical and Miscellaneous Revenue Act of 1988 7-pay test. Remember the number, 7 years. And I'll show you how to unmec it. The taxation of withdrawals under the MEC is similar to that of a non-qualified annuity withdrawals. So if you MEC your policy, you have to pay a 10% early withdrawal penalty before the age of 59.5, like IRA and 401k, which is inefficient. And if this policy MECs, banks generally won't let you collateralize or borrow against it. And then once a policy has triggered a MEC status, it cannot be reversed. So let me just kind of click on this link and I will show you this Investopedia. And we try our best to pick you links that are objective. Forgive me. Yep, that's okay. So I'm going to change the link. So this is Investopedia. A modified endowment contract is a term given to life insurance. These limits on the policies, we talked about this, but specifically a life insurance policy is considered by MEC by the IRS if it meets 3 criteria. The policies entered into June 20th, 1988 or after. So prior to June 20th, 1988, a lot of the high net worth people were doing this and they didn't MEC the policy because there was no such thing. It must meet the statutory definition of a life insurance. If you put too much premium into these policies, it's not defined as life insurance anymore. It's defined similar to an investment. The policy must fail to meet the 7 pay test. So you just have to pay for at least 7 years. The 7 pay test determines the total amount of premiums into life insurance within the 7 years is more than what was required to have the policy considered paid up in 7 years. But tax implications, if you MEC it for withdrawals beginning the age of 59 and a half, a premature withdrawal penalty of 10% may apply. So therefore it's no longer efficient. Unlike traditional life insurance, which are FIFO, first in, first out, it actually becomes LIFO, last in, first out. So you're taking the gains out first, therefore you lose a lot of tax benefit. So therefore, do not MEC your policy. So I just want to explain this because of the importance. So now I want to just go back to our slide, and I'm very conscious of time. We have about 15 minutes left. So I'm going to go a little faster. So you just need to understand the difference in definition of MEC, but overfunded cash value whole life insurance to avoid the MEC. Simple. This is the same thing I just showed you earlier in the illustration, but you know what the difference is? $1,050,000 base, 950. There is no more MEC. Why? Still the same 53,000, still the same 50,000 reoccurring, but simply, if you work with, yes, Nelson? Oh, I thought I heard you say something. What you need to do, if you're an insurance agent, financial advisor, you just need to quick pay the policy. So you need to stop premium payments in year 8, right before the MEC test stresses. So starting year 8, you just can't pay premium. Now, when you see this way, look, the policy is paid up. Your $1 million of death benefit continues to grow. And once it's paid up, you'll notice if you quick pay it, the death benefit drops slightly, but it will never lapse. Now, one thing I want you to understand is the efficiency of this policy. And I'm going to share with you the cash value. You put 430,000, you have 472,000. As Nelson mentioned, this is not used to compare against real estate, stock market, or any high growth vehicles. This is used to compare against safe, conservative, or low risk vehicles like your bank account. Now, I want you to understand, if I have 472,000 in my bank account, like Nelson has, and let's say this is a policy that Nelson has, if my 472,000, which today with the interest rate environment of earning 1%, how much do I earn in interest? 4,720. But how much does Nelson grow in his account? 22,000. His 22,000 plus the 472 is 495. My 472 gets $5,000, become 477. That's one area. And you know what's the second area, which is actually pretty terrible too? I actually get a 1099 for that 5,000 from my bank. Nelson gets this tax deferred, so he doesn't get any 1099. So you'll see the policy will grow continuously over time. But I want to point out one feature. Now, I want you to understand if you have 472,930 in your bank account and it grew 22,466 by the 12 months period, you take the 22,466 divided by the 472,930, it's a 4.75 interest. But if you actually understand that if we earn a 4.75 interest and pay taxes, assuming some of you are paying 35% or 40%, depending on what state you are, and if you're in the highest tax bracket, what we would generally say is divide this by 0.4. Oh, forgive me. Actually, it's 22.
You multiply it times 0.6.
Correct. Yep. Divide by, oh, it's divide by 0.6. Forgive me. So
multiply by 0.6.
930. This is number. It's actually divide by 0.6. I'm pretty sure.
Oh.
It's equivalent to 7.9% rate of return being taxed at 40%.
Okay.
If Nelson earns 7.9% in any vehicle and he has to pay taxes at 40% times 0.4, therefore he's netting 0.6, that's equivalent to 4.75. So this is a 7.9% pre-tax, right? But if post-tax is 4.75 as a vehicle. But let's think about another way. What type of number do I need to have in my bank account to earn 22,000 in interest? If I was getting 1%, I need to have 2.2 million. Because if my bank account had 2.2 million right now, sitting in checking and savings, and I earn 1%, I would get 22,000. Grow just like 22,000. And I'll still get a 1099 in the bank. So once again, you can see the difference on the tax deferral growth. Now with this policy, once you pay it up, pros of it is you never have to pay another premium again. But the con of it is if you want to pay premium, you may not, because once you make it paid up, contractually, the policies change to paid up indefinitely. But at 65, if we kept this paid up, your million would grow to 2.3. You would have put in a total of 430,000. You get back 1.6 million. You would have 4x your money. Or you can leave this 2.3 million into a trust and you left 5 times for estate planning or legacy planning. That's how you avoid and design these policies to avoid a MEF. But I want you to understand these dividends right now, which is 5%, depending on the insurance company, fluctuates year after year. So next year, as an example, the dividend goes from 5% to 6%. That's a 1% increase, but 1 divided by 5 is a 20% increase, right? That 1% divided by 5 being 20%, what happens is this 50,000 that you're overfunding, you might have to decrease it by 20. That 20%, 50,000, now you can only overfund 40,000. Because if you continue to overfund the same limit, when these dividends go up or go down, you can MEC it sooner than you think. And once it MECs, once again, you can unMEC it. This is the example. Now, one of the biggest questions I get from clients all the time was, Rick, what if I can overfund it this year? I can't overfund it in my second year because something happened at work, or I didn't get my RSUs, my bonus, or whatnot. So overfunding cash value life insurance, flexibility to reduce or stop overfunding. This is how I would design this to the leanest way. So the 1 million is the exact same, the 54,000, I'm going to zoom in. The first year, and this is actually very similar to another existing client that we did. They did 1 million, they overfunded by 53,000, 53, they got back 48. But the second year, they're like, crap, I can't overfund 53,000 anymore. Can I pay the bare minimum? Yes, you just have to pay the bare minimum to sustain this death benefit. It's 3,000. Now you don't want to stop paying the premium because you remember how you MEC a policy if you stop paying and it doesn't meet the 7-pay test. So what we would design is just pay the bare minimum for 3,000 a year for 7 years. And then we do a paid up and you will drop the death benefit to the bare minimum. It'll be 186,000. And you'll notice you put in 53,000, 48. The second year, you're already getting arbitrage. But because you're putting such a low amount, the compounding rate is a little slower. Therefore, your break even is your 5 as well. And then starting year 8, there is no more premium as well. So I went over these illustrations quite fast. I have about 10 minutes left. So if you have questions, let's save it at the end. But one question I always get is, Rick, as a wealth management advisor, which companies do you recommend? So our firm partners with over 30 insurance companies in America. Now, if I was to design this for any of our clients, I would design this with your best interest in mind as a fiduciary. I always want to go to the top insurance companies and that ones that are paying the most dividend. Cash value overfunded whole life is dependent on who pays the most dividend because dividend impacts your portfolio performance. So in 2021, last year, the #1 life insurance company that pays in dividend, 5.8 billion, was Northwestern Mutual. Number 2 is New York Life. Number 3 is Mass Mutual. And I'm going to pause right there. Generally, when I design these policies, I try my best to go to the best dividend paying company. If Nelson can't get approved with #1, I'll go to number 2. If he can't get approved for number 2, I'll go to number 3. If he can't get approved for number 3, then humbly speaking, this cash value overfunded infinite banking concept may or may not work for the client. The top 25 US life insurance company based on direct premium, if you actually look at which companies that are biggest in America, Northwestern Mutual, 15 billion. New York Life is 10 billion. Mass Mutual is 9 billion. So we normally just recommend these 3 companies for our clients, depending on their cash flow and suitability. And I want to show you an example. This is the 20-year actual cash value whole life example. So in 1993, a 45-year-old male bought 250,000 cash value whole life, and they funded to 2013. And one thing I want to explain that's really important, in 1993, these were the dividend interest rate. And these are public information, which all of you can Google. Northwestern Mutual was giving 9.25 for their best client health, 9.25 for their second best, 9.25 for their third best. Mass Mutual was giving 9.45, New York Life was giving 8%, Guardian was giving 9.75, MetLife was giving 8.8, Penn Mutual was giving 9.75, and State Farm at that time wasn't giving any. Now, based on my math skills, which is fairly good, what I would purchase based on simple math is no-brainer, Guardian. 9.75 is the highest, but be very careful. Dividend is not the only factor that impacts your performance. There's mortality expense, there's investment yield, there is lapses, and there's overall expenses charged to the company. So overall, when you look at all these factors, that's just gross dividend. If you actually look at the IRR after 20 years, Northwestern Mutual Policy gave a 4.67 IRR. That's their best health client. Their second best health was 4.1, third was 3.5. Mass Mutual was 3.4, New York Life was 3.4, and then Guardian was 3.1. I'm going to draw a straight line here. The reason why I draw a straight line is I don't try this for every company, because if you think about it, if inflation was about 3% the last 30 years, any company that's not giving you at least 3% internal rate of return after 20, 30 years, I'm not a fan of. I'd rather you buy term and invest the difference. I'd rather you invest in other vehicles, because then it's no longer efficient. So the reason why so many people in the media says, oh, this doesn't work, is unless you're buying from the top 3 dividend paying funding companies, every other company, in my humble opinion, doesn't work for cash value overfunding life insurance. Now, here's the dividend rate. One of the things we always get is, hey, Rick, how consistent are these dividends? So every insurance company publicly display all their dividends. So Northwestern Mutual, for example, has been giving dividends since 1872. And they've been giving dividend every single year to 2022. So in 2007, 2008, during the Great Recession, they were giving about 7.5%. In 2020, during COVID, when S&P 500 was down over 30% in the month of March, they were giving 5. And in 2022, they're giving 5 when S&P 500 is down double digits. So one thing I want to mention, this is not supposed to be the highest rate of return. This is used as leverage, especially if your other accounts have risks that can go up and go down. And here's a question that I often get asked. Rick, when you design these policies, do you prefer cash value whole life, variable life, universal life? We have access to all of them. I don't have any specific preference. It depends on what the client prefers. But I want you to understand, when it comes to leveraging these policies, you must have at least 60,000 for banks to allow you to borrow against it. Now, generally, bank says if you have cash value whole life, they'll let you borrow up to 95% of the cash value. That's a great amount that you can leverage. But if you have variable universal life, it's only 75%. So Annie, you asked me a question, Rick, would you recommend cash value whole life or IUL or variable life? I don't know. But if you do IUL or variable life, if this institution only allows me to borrow 75, when I do cash value whole life, it allows me to borrow 95, which one is better? That's number one. Number two, when you borrow against this, some institutions up to prime, up to 250,000 borrowing rate, you only pay prime. Payments are interest quarterly, 5 years renewable, no closing costs, no, and the money is wired to ACH or wire transfer. That's one example. Another institution, Valley National Bank, they even say the cash value in your whole life policy can help you access the money you need. So they don't lend to variable life or universal life. So once you do other products, some banks may or may not lend to you. Their lines range from 65,000 to 5 million. It's easy to access. There's no application fee, depending on the state, competitive variable interest rate. Interest may be tax deductible. Consult your tax advisor, depending on your tax filing status, and multiple policies can be collateralized on one line of credit. Time frames to access funds. How fast can we have this access to liquid funds or withdraw with insurance company? With insurance company, it generally takes 3 business days from your request. Timeline of withdrawal and application process for collateral assignment with banks. So when you want a collateral to a bank, process application and underwriting with banks generally take 4 to 5 weeks. Once you're approved, the ACH can be sent to your bank account within 1 to 2 business days. What's the flexibility contribution? You can increase or decrease contribution anytime. Best to call days 2 days prior before the draft date. Decreasing your contribution does not need underwriting or approval, but will need to run a MEC test, because if you decrease too much and you fail the MEC test, it can still MEC within 7 years. But increasing your contribution may cause a MEC. That's more difficult, and additional underwriting will need to run MEC test. If annual premiums are paid, so for example, if you put 54,000, like that other example, when would that 48,000 reflect? Generally, updated cash value will reflect in policy within 5 to 7 business days. So overall, funding cash value whole life strategy versus cash in a bank. Number one, liquidity of funds. Both are liquid. Especially if you're buying real estate, isn't it true you wouldn't put your money in the stock portfolio because it can go up and go down and it's no longer liquid? It's considered a safe asset. This is an asset on your balance sheet that you would disclose to your bank, especially when you're doing lending. Flexibility design. You can scale up and scale down just for the MEC test. It's tax efficient, tax deferred growth, and you can withdraw income tax free. Ability to leverage or borrow against. If I had $1 million in my bank account, can I borrow against it? You can't leverage your bank. You would just withdraw it. If I had $1 million in my cash value whole life, it can withdraw. I can then borrow 950,000 and buy real estate with Nelson. And that 950,000, as long as it's growing higher than the interest rate I borrowed against, the real estate growth, and my $1 million cash value life insurance is still there. It's more competitive rate of return compared to banks, and you have a death benefit feature that obviously the bank account doesn't offer. 3 reasons why most insurance agents or advisors do not recommend infinite banking design life insurance policy. Number one, it's very difficult. This industry is very difficult to succeed in. Most insurance agents or financial advisors are not making it in this profession. Statistically, less than 10% make it to their 5th year. They just don't make it. It has a very high, has a very low retention rate. Number two, because it's a very difficult industry to succeed, most professionals do not have the knowledge to understand or create these policies because of advanced product design. They just don't know how. And number three, the ones that do make it in the business, the ones that do know about this, find it very tedious and difficult to service because of the possibility of MEC. Those next 7 years, as Nelson and I engage in our relationship recently, I have to talk to Nelson, whether he likes me or not, every year for 7 years because I have to stress test his policy, right? They do not want to service this because traditional cash value whole life doesn't MEC. It's very simple and easy to maintain. And then finally, I always end my presentations with a quote. If you're planning for a year, sow rice. If you're planning for a decade, plant trees. If you're planning for a lifetime, educate people. The reason why I do this each and every day is to educate you all. As Annie and Nelson showed me, the mission of Subtle Asian Real Estate is to really empower the minority community. So thank you all. I know I'm 1 minute over time. If there's any Q&A, I have no problem staying and answering.
All right, thank you for your time. We'll just jump right into the questions. Starting from the top, Judy asked, how much wealth is considered a high net worth individual?
I think that's a more subjective question. You can read stats. I think I read recently on Wall Street Journal that a high net worth individual, and it's a sliding scale, is someone that has over 3.5 million net worth. Personally, to me, I know I said earlier, I work generally with high net worth individuals and ultra high net worth. That's not really the criteria we focus on. We're just saying that because we're in private wealth, most of the conversations we're having with clients are extremely complex and difficult. So therefore, so high net worth is subjective. To me, it doesn't really matter how much you make. You can make $1 million and spend 1.1 million. You're probably not the right person to be learning this concept. But if you make 500,000 and you're spending 200,000, this is probably a strategy that may be helpful for you.
Adil asks, is this the same as an IUL? You explained it earlier a bit, but it's slightly different than an IUL.
We are licensed to recommend IULs. I'm very knowledgeable about IULs. One of the flaws about IUL, depending on the company you apply with, there is a 10-year or 15-year surrender charge with IUL. So we have clients, friends, and family that in the past had bought IULs. They tried to use this concept and they looked at the column that says surrender charge and they realized if they liquidate within the first 10, 15 years, they actually have a huge discrepancy in how much they put in and how much they receive back. So oftentimes we find that IUL doesn't really work well in the first 10, 15 years because of the surrender charge.
So someone mentioned that they have an IUL and a VUL. The IUL has a cap if the market goes up by double digits for their product. Is there a cap for this product?
There is no cap. The dividends is determined by the insurance company's general account. But IUL, VUL, and cash value whole life we have access to. One thing I'll share with you is VUL and IUL, just as an example, Valley National Bank won't lend you any money to collateralize. Defeats the purpose of the leverage. Then you go to M&M Bank and they say, hey, we'll lend it to you. We'll lend you 75% of your account value, while they lend Nelson 95%. They're like, darn it, that's not fair. How come Nelson gets 95% leverageability and I only get 75? That's the problem. But once again, VUL and IUL, if you look at the account values, I don't want to talk about pros and cons of IUL, VUL, which I can always talk about. I also have UL products for my family and I, but those products may or may not work as efficient because think about it. You want to leverage, I'm not comparing this to the stock market or real estate. Once again, then you might want to compare VUL, IUL to the stock market or portfolio. I'm comparing it to checking, savings, and your bank account. Now, if all of you were about to buy a home closing in 6 months, would you wish your money was in the IUL, VUL, or the stock portfolio because you know you're going to close in 6 months? Or would you wish it was in something safe, liquid like your bank? Most people would say, I want it to be in a bank because I'm about to make a real estate play in 6 months. But then why are you putting IUL, VUL that fluctuates? So for example, year to date, VULs and IULs are down. Now, I know what you're thinking. IUL has a ceiling cap and has a floor that can't go down. But have you actually looked at your net surrender value? Have you looked at your net surrender value? Because it's very easy to take a financial calculator to calculate the net return in the IUL. Look at when you have arbitrage. as I mentioned, these policies designed in 2-3 years, dollar for dollar, you get more back. In year 5, you could cancel and get all your money and profit. IULs, if you could show me an IUL of year 5 that you have net profit after surrender charge, then it's a very efficient vehicle. I haven't seen an IUL to do that, especially after net surrender charge.
Yeah, I'll give an example. So some of you might have a 6-figure amount of cash waiting for you for your next real estate purchase, which as real estate investors, we all tend to have, because if you are buying your next property, it's likely going to cost you some 6-figure amount of money. Now, inflation is 9%. So you can either eat it at 0.1%, like whatever interest rate in your checking account, or you can get something that's maybe 5 or 6%, from one of these like vehicles. And the idea is that you borrow against it for any real estate purchases. And then when you borrow the money, the interest rate goes back to pay into your cash balance. And so the idea is that you can move quickly and you don't have to let your money necessarily eat it to inflation. And so it's a way to protect cash that you're storing rather than necessarily maximizing like your upside or downside, which is kind of what Rick is referring to. How much longer do you have to pay generally higher fees with some of these life insurance products? Most of the monthly payment goes to fees for the first 10 years for their IUL product. Is this similar?
Great question. So once again, I am licensed for IUL, VUL, UL, GUL, term, whole life, you name it. We have licenses. I have a Series 7. I can talk to you about stocks. I can talk to you about private equity, hedge funds. We'll save it for another day, private real estate, REITs, and other things. But one thing I want to mention is that illustration I showed you in that simple example is 5 years, you put in 5 years, you notice the arbitrage, break even. But IUL, as that person that asked the question, yes, if you actually look at every column and read every page, which most people don't, the first 10, 15 years, the surrender charge, most of them don't even break even.
Got it. Annie asks, what is the payback time period like? Which you went over as well.
Yeah, the payback time period is, this is generally IO. It really depends on how you're borrowing it. So as long as you have 60,000 or more, you can collaterally assign this to the bank. If you have 60,000, less than 60,000, then your only option is borrowing from the insurance company. I'll give you a great example. We had a client, let's say they had 100,000, and they were getting married. And they're Asian, so they said, hey, Rick, I need $30,000 next month for my wedding. And then because I was in the wedding party, I said, what is this $30,000 for my wedding? I said, great. Are you looking to borrow it and pay it back after your wedding, considering it's an Asian wedding, if you have a certain amount of cash? Like, yeah, I'm probably going to use this to pay all my vendors. And then a week later after my wedding, depending on what gifts I receive, if I have cash, I want to pay it back. Then you know what I said? Borrow against the insurance company. The reason why you want to borrow against the insurance company generally charges you prime +1. So if prime is 5.5 right now, +1 is 6.5. Let's say she borrows, for simple math, $10,000 at 6.5 interest rate. That's $650 a year. She borrowed it for 2 weeks. You divide it by 12, it comes out to less than $60. She gets access to $10,000, $60 interest. She just pays $10,000, $60. It's probably less than withdrawing from an ATM. That's an example. But if she borrowed, if she also has investment with us, she's like, well, Rick, what if I took the $10,000 from my investment account? And I say you have long-term capital gains or short-term capital gains, and $10,000, even at 15%, that's $1,500. What's better, to pay the $60 interest back into your account, or would you rather pay the $1,500 taxes? No brainer. She borrowed against it. But if you borrow against at a bank, you only pay prime generally. So Rick, why would I pay 6.5 when I could pay the bank 5.5? Because when you're paying back the policy with the insurance company, the $60 interest goes into your accumulated value. But be very careful when you do it that way, which is very stressful for us. We have to do a MEC stress test again. So when Nelson borrows against it, and he's like, Rick, I'm paying it all back and $10,000 interest. I was like, damn it, Nelson. I told you it's going to MEC in year 9. That extra 10,000 MEC'd in year 5. All right. So I said, Nelson, don't pay all that interest back at once, because as long as it MECs in 7 years, I can't undo it. So when you borrow this and paying it back, it might MEC within that 7-year period. So be very careful. I've seen people borrow against it, and when they pay the interest back and how it's designed incorrectly, it MECs. Then it's inefficient. So, but if you borrow against the bank, they're just going to say, hey, $10,000, 5.5%, right? It's $550. But if you pay back the bank, it doesn't go into your policy. You're paying back the bank. The bank earns all that interest. So my humble opinion is, depending on the scenario, that's why we're a wealth management advisor. We'll guide you every step of the way. is if you're going to do this for a short-term loan. So for example, Nelson buys a fix and flip in 3 months, he's going to burr it, refinance it back out, and he paid back deposit, borrow from the cash value life insurance. If Nelson's going to buy a piece of land and he's going to build 50 units and condos and space, and he's going to do it for 3 years, I'd rather him borrow the lower interest because his required IO payment is much lower, so it doesn't drag on his cash flow, and he can have a higher net income. In case you're wondering, I'm also really knowledgeable about real estate. So personally, my father's a real estate developer. I also have a sizable real estate portfolio. So all the things I'm teaching you is exactly what people do. Yes, next question.
It's basically a double perk also. When you're buying real estate, you pay maybe 3 or 4% or whatever the interest rate is, but then you still earn money on the dividends of the value. So the value of the portfolio still goes up, but you have a loan now you can use to invest in another product at the same time. So that's kind of a reason you get to like make double earnings from it.
Yeah, so because if you had $1 million in a bank, if you wanted to borrow 500,000, it's either a personal credit line. The bank may lend you money, but they won't really look at the $1 million of your bank. But if you have $1 million in this policy, so most people have $1 million in bank, you know what they do? They draw 500,000 by real estate. So they have 500 in bank, 500 in real estate. If you have $1 million in this policy, you borrow 500,000, you have $1 million growing for you in the policy, and you have 500,000 leverage that you can invest in real estate. So therefore, it's more opportunistic depending on what you're looking to do to build wealth.
And he asks, if I run into financial issues such as losing a job, etc., can I pause the payments?
Correct. So Annie, remember, once we design these policies, I would just tell you, here's the minimum, bare minimum, and here's the maximum you can go. So if Annie, that perfect example earlier, if you're like, Rick, I just did a sale deal where I have a couple 100,000 and I want to overfund 50,000 here for 5 years. After 1 year, you say, can't, I would just ask you, Annie, the minimum for this policy is $3,200 a year. It's $260 a month. It's probably less than what you're paying for your car payment. Do you think you'll ever get into financial hardship with even the $260, the bare minimum you can't sustain? If she says yes, then we'll probably design it not at $1 million. We'll design it at 500,000. 500,000 is now 1,600 a year. It's $120 a month. Most people's cell phone is more than that. Do you think that's minimum to sustain? So we can design a scale any way you want.
Kevin asked, he mentioned that there's also a rider that if you can't work anymore due to disability, the premium is waived, but you have to pay for that, right?
So
that's like an extra premium.
Yes, Kevin. That's called a waiver premium rider. Kevin is very knowledgeable. Good job. So what that simply means is if I get disabled and I use myself and I'm unable to pay the premium, guess what? The insurance company is going to pay my premium. Yes, but what was my premium? You're absolutely right if you guessed $3,300. But will the insurance company overfund my policy for me? Absolutely not. So the waiver premium protects the regular schedule premium. It does not protect the overfunded portion. So therefore, one thing I always recommend when you're doing these policies, but once again, if you fundamentally did the 54,000 year one, the second year you get disabled, we just have to minimize it to the bare minimum. Make it to the 7th year. 3,000 times 7 years is $22,000 approximately. And then it doesn't MEC, and then we pay up the policy by dropping the death benefit, and it'll never MEC again.
Got it. Sunny asks, it's guaranteed but not guaranteed. Could you explain how the returns work?
Great question. It's guaranteed to grow. It can never go backwards because insurance companies, they take your premium and they're required, like banks, to put it in very safe vehicles, AAA rated. For example, like government bonds, 10-year treasury. So those generally can't go backwards. 80 to 90% of an insurance company premium for cash value whole life, they're putting it into government bonds and 10-year treasury. So if 10-year treasury right now is giving you 3%, that's why the insurance company is offering you 5%. If 10-year treasuries go up, guess where dividends may go? You got to sit right. This is actually a great leverage. If you think interest rate rises, generally interest rate going up actually helps cash value whole life. Interest rate goes down, hurts cash value whole life, which is actually a great hedge and leverage against our stock portfolio and our real estate. But so the one thing that's guaranteed, it's guaranteed to never go backwards and it's guaranteed to grow. But what's not guaranteed is your dividend. Because right now, insurance companies are giving a 5-6% dividend. Next year, can you guarantee they'll give you 5-6? No, because throughout the year, they're going to look at their expense ratios, their mortality costs, they're going to look at their investment yield, and they're going to look at their lapses. Based on those 4 factors, then the insurance company around October, November time announces their dividend. Once they announce their dividend, our team of 10 looks at our entire master list of clients that have done these overfunded cash value policies. And then we call our clients and say, great news. The dividend is the same. You can fund the same. You're like, Rick, great news. It's the same. believe it or not, when the dividend went up recently, because interest rate in 2018, 19 went up slightly, I was like, hey, Nelson, interest rates went up. It's like, yes, instead of funding 50,000 because of the arbitrage in interest rate, you can only put in 40,000. So be very careful as dividend goes up, you overfunded based on the ratio because you have to calculate the end of the 7 years. Are you making too much money where the IRS deems these not as life insurance? So if dividends go up, you can't put as much money. If dividends go down, then you can actually put a little bit more, possibly do a max stress test. But dividends the same. That's the easiest for us because then we just say, hey, Nelson, dividends 5%, it's the same number. But if I were to take a guess where dividends are going and I don't know, I would guess 51%, of course, is going up. Federal Reserve already raised interest rate 4 times, right? Jerome Powell at Jackson Hole, Wyoming, a few weeks ago has said the things he said. I don't want to say what he said on this Facebook because he said the word pain, quote unquote, pain. So therefore, he's going to raise interest rates to control inflation because that's his number one focus. And therefore, if interest rates are going to go up to control current high inflationary pressure, guess where you think 10-year treasuries or government bonds may go? So that's all.
Got it. Next question, Niraj Ash, that his wife currently have term life insurance, but also whole life with a cash value. Should they drop the term and then buy the wife whole life also?
Great question. I was it plead the fifth? I can't answer that question without knowing anything about you. It's almost like, hey, my father got the blue pill from their doctor. Do you think I should get the blue pill? I don't know anything about you. So the answer is no, don't make any changes. Speak to a financial professional. Because here's the thing, I'll put myself in your shoes. As I watch this for an hour, and that's why this is all for educational purposes. I have zero self-motive. My only motive is to educate you all because Nelson, Annie, Kevin, and some of you are friends of ours. So what I want to do is just teach. So if you said, Rick, I'm just using an example. I have 100,000 of traditional cash value whole life. If you have regular traditional cash value whole life, it won't be used the same because as you remember in the example, you don't start seeing break-even points until you're 12, you're 13. All right. But if you have term life, let's say you have 500,000 cash value traditional whole life and you have 3 million of term life. And then when you watch this video, you go, you know what? I don't like term life. I'm going to cancel it hypothetically, but you have a $2 million mortgage. That's against my fiduciary rights, right? You need insurance. So I always tell people if money is not an issue, permanent insurance is better. If money is an issue, get a lease term. Get a lease term. So my wife and I have over 20 million of life insurance. I have a good portion of permanent life insurance. Half of it approximately is permanent, 10 million. Half of it is term insurance. But I love term insurance for the right reasons, right? Because if anything happened to me yesterday, I got to pay for my mortgage. I got to continue to put my 3 kids in private school and my wife stays home with her kids. So therefore, don't cancel anything until you speak to a professional. But my biggest advice to you is don't watch something, read something and say, do a knee-jerk reaction. Really analyze, understand your whole scenario. Right. So, and also I can't give you advice because I'll give you a great analogy. There was once a person many years ago, a high political figure that went on social media and said drinking bleach will kill COVID. Guess what happened? Did he go to jail or did he get his license revoked? Because he didn't, because he doesn't have a medical license, because freedom of speech. But imagine a doctor, some of you may be doctors watching this, and you go on your Twitter or social media saying drinking bleach may kill COVID. Guess what may happen? You might get a medical board calling you and say, your license is now revoked. So therefore, you have to be very careful of what you're reading, what you're listening to, because someone like me with licenses will not give you advice without knowing anything. Sorry, hope that was helpful.
Deal asks, can they pull the premiums paid from term insurance and then put it towards whole life, or does all the money they put towards term pretty much go away?
Term insurance, the best analogy I can explain is like car insurance, right? It has its purpose. I love term insurance. I'll give you an example. 10 million of term insurance for me is $300 a month. It's less than my minivan payment because I have 3 kids. So think about it. If I can afford a minivan that costs me $600 a month, why can't I buy $300 a month of term insurance? But last year to this year, I didn't pass away. Guess what? The insurance company, I can't call them and say, hey, I gave you $300 a month for 10 million of insurance. I live. Can I get my money back? No, Rick, it doesn't work that way. We protected you for that period. Just like if I sold my minivan this year, I can't call Geico and say, Geico, I sold my car. I didn't get into any car accident. Can I get back my premium? No, it's just protection. Now, I wouldn't recommend you to cancel your term and put it to cash value whole life. I'll give you a great example. My 10 million of cash value whole life for my family, I'm paying over 6 figures. If I canceled my 10 million of term and all I saved was $300, you know how much cash value whole life over fund I can afford? 5,000, 10,000. What is 10,000 of cash value whole life worth versus 10 million of death benefit? the 10 million of death benefit serves its right purposes. The cash value whole life serves the other. But if you need to cancel term to afford cash value whole life, then you're not the right candidate for permanent life insurance, respectfully.
Jeff asked, do we have to do this every 9 years? No, this one is a blended / whole life term. So just goes into perpetuity until you die. Johnson mentioned, oh no, they have IUL, VUL, and term, but no traditional whole life. Each their own. V said some carriers have term conversion options, but yeah, you should contact your carrier to figure out if you can transfer it over. Sunny asked, what are the fees associated with the policy? This is a quick gut check that I used. I was advised by. Could you pull up that sheet again for like over whatever years?
Yeah, yes.
I asked one of the high net worth families that I talked to, when they picked it, they just said, look at the first year and then try to figure out, go up.
I'm going to just show you this policy. I don't want to mech it. So this is the best way to show you.
Okay. So what they said was try to look at how much of the first year's policy goes towards the actual cash value. And so I think when the one that Rick got for me was like 12 or 13% of my value in the first year goes towards the actual cash value, or sorry, 12 or 13 goes to the premiums. So like 80 something % of it goes to the cash value, right?
Yep.
So for me, I was like, well, the cost is probably like 12% of my premiums. And then the idea is that around year 3, the premiums start making more money than I would put in every month to pay the premiums. And then by year 5, the dividends make enough to make up for the premiums that I paid. So basically you're eating the cost for the first 5 years, which is, I think you mentioned front loaded. But to me, I'm okay with that because I'm only putting in, a small 6-figure amount of money to use it to invest in real estate. It's a cash balance, right? So like, I can borrow from it at any point to buy real estate. And then the idea is in year 5, I'll have something that's crushing compared to the savings bank rates that I would be getting normally. Plus I get life insurance, I guess. So,
Yep.
which is what it's supposed to be used for, which is what I'm using it for, IRS, right?
Well, yes, for Nelson, not married, don't want to be kids, that makes sense. For me, married with kids, I really do need this death benefit because especially with COVID out there for my family, it's very important. But yeah, you put 53, you get back 48. Year 1, you get 48. So you can just see the cost of insurance is $5,000. Year 2, 53, 51. See, 51 plus 40 is $100,000. So your cost of insurance is $2,000. Year 3, just pure profit.
Eddie Min asked, is the accumulated value tax-free?
Accumulated value up to your principal is tax-free, FIFO, first in, first out. So for example, if you have 268 to 273, you can get all your principal. You can ask the insurance company, hey, I want every dollar I put in as a cost basis, they'll give it to you income tax free, no 1099. But anything above it, you do have to pay income tax. But why is it called tax free? Because you can borrow against it. Because borrowing anything, so a good example, when you borrow $500,000, when you make $500,000 from your employer, you pay income tax. When you borrow $500,000 from your bank to buy real estate, how much income tax you pay? That's why in America, the ultra high net worth people, you know what they're doing? They're showing in the beginning maximum income to get maximum leveraging. Then once they get all the assets, they show minimum income, maximum asset, then maximum borrow. And you show minimum income, but in order for you to have maximum asset, you must have actual income to buy assets so that you can borrow from a bank. Once you have maximum asset, show minimum income, and you just leverage your asset to borrow. That's exactly how high net worth do by minimizing your income tax liability.
Okay, and then Jason also responded with Eddie. But yeah, if you make too much earnings from the policy, it becomes a MEC, and then you have to pay taxes on it from the earnings that you receive, and then it's taxes as ordinary income. So that's why it's important not to MEC it.
Correct. That's why you have to talk to your insurance agent, your financial advisor every single year to stress test it.
Okay. Eddie mentioned were the return rates locked in over the total course of the project?
Nope. The dividend, once it's announced around October or November time, it's guaranteed for that following year. So if you look at these dividends, and I showed this earlier, you could close your eyes. I don't want to hurt your eyes. So look, so in 2000, as I mentioned, the dividend went up. So the reason why I started as a wealth management advisor in 2007, you see the dividends keep going down. Rick, why does it keep going down? Because the interest kept going down. But in 2018, it was 4.9, and in 2019, interest rate went up. If you guys recall, when you were borrowing money to buy real estate, that time when it went up, the dividend went up. So these dividends are not guaranteed, which I mentioned earlier, but they are guaranteed to never go backwards. And you always want to be with a AAA rated company and a mutual life insurance company. So in America, there's only a handful of mutual life insurance company. The three that are top are Northwestern Mutual, New York Life, and Mass Mutual. I have access to all.
What's a mutual company? Why is it different than the other life insurance companies?
Perfect, great question. So in the world of life insurance, there are two types of insurance companies. There are publicly traded insurance companies and mutual insurance companies. About 50 years ago, there were 100 plus mutual companies. Now they're less than 10. What happened to those 90 companies? They demutualized and they became publicly traded company. A great example is MetLife. MetLife used to be mutual, privately owned. When they demutualized and they become a publicly traded company, guess who MetLife owners are? Stock and shareholders. They have to appeal to board of directors. They have quarterly earning reports and their stock prices. So when a publicly traded company makes any profit, if you look at the hierarchy of paying out dividends or interest, they have to pay to stock and shareholders first. Policy owners or life insurance clients like you and I, if we went with a publicly traded insurance company, are generally very minimal. But a mutual insurance company, they're privately owned. You know who their owners are? They're life insurance owners. So when they give out forms of dividend, most of the dividends go back to you and I, the policy owners. So right now in America, there's less than 10 mutual insurance companies. And I'll share with you, as I've done my due diligence researching it, Northwestern Mutual is AAA rated. New York Life is AAA rated by every rating company. And then number 3 is Mass Mutual. Now, I will share with you, there are always going to be pros of every company and there's always going to be con of every company. Why? Because there's competition. There's competition, right? So I don't know if you believe every review you read online is actually real. I have nothing to say. There are two types. 80% of reviews online are actually by competitors. That's number one. And number two, Northwestern Mutual and New York Life, they're actually companies that are exclusive. Unless you have a direct relationship or contract with them, you can't offer their products. So both of those companies combined probably have 20,000 advisors. There's over 1 million people in America doing this. So only 2% of financial professionals can offer those two companies. That means 98% are the competition. Do you think that 98% is going to say good things about those companies or bad things? Think about it. But in order to offer those company products, you have to have a relationship or you have to be a certain tier as an advisor. Based on the amount of volume, business, and our ranking in our industry, that's why we have access to the top 3. Northwestern Mutual, New York Life, Mass Mutual. In my general humble, if I can't get you those top 3, through cash value whole life, I'm not talking about VUL, I'm not talking about IUL, I'm not talking about GUL, because IUL, VU, and GUL, those are performance-based. They're not tied to the insurance company. Those are tied to the index, right? So therefore, how much liability does the insurance company have? I'll give you an example. I have VUL personally for my family and have cash value whole life. Guess when I bought my VUL? You're absolutely right. I bought it in 2020, in April 2020, in fact, because S&P 500 was down 30%, and I was going to put money in permanent life insurance. Now, I saw the S&P 500 go down 30% in April. It was too easy of a decision for me to put money into variable life because the market was such discount that I saw a lot of opportunity. So I did variable life. But cash value whole life is guaranteed to grow and can never go backwards. So the insurance company actually has more responsibility to perform and to give out dividends to cash value whole life. VUL, this year, you know what my VUL is performing? Is down double digits. The market is down double digits, but my cash value is up 5%. Once again, this is not meant to be a silver bullet. Where I think the society and the media portrays things, which is absolutely incorrect, it's a one-size-fits-all. That's not true. I truly believe the best financial plan is not one strategy over the other. Imagine you're reading books from Robert Kiyosaki, Rich Dad Poor Dad. He's going to say, buy real estate. Duh. Then you read a book from Ray Dalio. He's going to say, buy stocks. Duh. You read a book from, I don't know, Dave Ramsey. He's going to talk about something else. Susie Orman, he's going to talk about something. You read a book about an insurance company, talk about something else. But in my humble opinion, it's actually not one or the other. It's actually understanding them all. So my personal opinion, here's the perfect financial plan. I love stock market because of the liquidity feature. And if you look at that last 30 years, the rate of return is very competitive to real estate. Why don't I love real estate, even though I have a lot of real estate, is because real estate, there are certain types of risks, right? In 2020, I had 3 out of my 7 properties, the tenants weren't able to pay rent. Did I have costs? Yeah, I had HOA fees, I had maintenance, and I had property tax. But in 2020, during that March period, when my portfolio went down 20, 30%, like the S&P 500, did I have to pay more to my portfolio? So real estate, there are going to be continuous costs, whether you like it or not. Stock portfolio, I put 100,000 in my stock portfolio. I don't want to put any more money. It's going to go up and down. I buy 100,000 real estate. I get a call from my property manager say, hey, the roof caved in. I was like, I caved in. All I had is 100 grand. No, you need to pay 20 grand to renovate and fix a new roof. I'm scratching my head. So I love stocks. I love real estate, and I love Cashflyholic, and I'll tell you why. I love stocks for growth, flexibility, and liquidity. I love real estate for tax deductibility and depreciation and appreciation. And I love Cash Value Whole Life for simply guarantee, safety, and I'm going to use it to pay my estate taxes. Because all of you build real estate like Nelson, Annie, and Sarah's teaching you, most of you are going to have an estate tax problem. And if you think about the estate tax problem, I've seen this. I had a client had 10 real estate properties. God forbid, when they passed away, their spouses, unlimited marital estate transfer, but their children have received it. Let's say that, and let's not talk about the estate tax numbers. I know it's going to sunset in 2026, at least proposed by Congress. But when they have to pay the estate tax, right? They have 10 real estate properties. Are those 10 real estate liquid? No, they had an estate sale. That's the problem. So I just want to have cash. So every vehicle has its own purpose. But my ideal financial plan is not a 3-legged stool. It's actually having 8 legs in your stool. Even if 4 of those legs crash, your stool will not fail. So that's my answer.
All right. HLS, is the idea of infinite banking the same as borrowing from the cash reserves of the insurance company? Not exactly. It's borrowing from the cash balance of your policy that you borrowed against. So that you own. So like the life insurance policy is worth, like, it goes up in value. A portion of it goes to premiums, but a portion of it goes to cash, and then that cash value earns dividends, And so the idea is that you can borrow against the value of that balance over the years. And it's not the best return if you're comparing with the stock market, but it is way better than just a savings account, which is why I'm using it. It's only for my savings, not really anything else. So
once again, 472,000 in year 8, and then it just grows 22,000. That's a 4.75% after tax. Is it a great vehicle? No, but 4.75 tax deferred and just grows to 495, 518, 543, 569. It's great for me. And for many of you, I don't know the age group here. Think about it. When we're young, we're taking more risks. But when we're older, are we supposed to take risks? And I'll tell you why. I realize, and this is my core belief of arbitrage. If this was my policy, right, during my first 10 years, my stock portfolio, my real estate portfolio is going to take the max amount of risk. That's why I can go up and go down with high volatility. While this cash value whole life is earning me a measly 4.75, not attractive at all. But now, if this was my portfolio at 60 years old, I'm 60 years old. Am I going to take 100% stock reposition? Am I going to do a lot of buy, flip it deals? May or may not. But look at my cash value. You'll see right here, 59, 1.2 million. If it grew 59,000, 59 plus 1.2 million, that's a 5.5%, right? That's amazing with zero risk. The older I am, just guarantee growing. All right. There are 2 things that I always teach people when it comes to building wealth. There's 2 definitions. You can't have the emotion called greed, and you can't have the emotion called fear. If you have greed, generally you make the wrong decision. If you have fear, you make the wrong decision. I'm actually also coming out a book soon. It's called Unleash. I think I told Nelson this. And I came out with the idea of writing this book in 2020 when I had 5 clients pass away, including my great uncle. And in 2021, I had 3 clients pass away, including a client who's Asian, had mental health issues and committed suicide. And at that point, I thought to myself, none of this really matters. Everything I'm teaching you all right now are just numbers. None of it matters. What matters the most is happiness and my core belief. But Unleash, the idea of it is live every day like you'll die tomorrow. So today, you'll truly live life fulfilled. So once again, I know if we're always thinking about chasing rate of returns, that's great, but you have to understand risk-adjusted return. So when you're comparing stock portfolio to cash value whole life, it's like comparing a minivan to a Ferrari. So that's all.
So Tui asked, how do I leverage the cash value then for real estate? Is it the same as doing a HELOC? Doesn't taking a loan from an IO require payment with interest as well? What's a difference advantage then? As Rick mentioned earlier, you do the whole life or whatever, the blended term version here because you have a guaranteed return because it's working off of treasuries. Never in the history of, have they ever paid a negative or not paid a dividend, right? And so the idea is that if you have savings account, it's going to beat the savings account pretty much for as long as you need it to. Then say you have a cash balance value of like $100,000. I want to buy a house worth $400,000. So I borrow $100,000, but I don't borrow the full 100. I'm capped at 95%. So I can only borrow 95,000. However, with the IUL, it's 75,000, right? Was that my understanding?
Depending on the bank, depending on the company, but
depending on the company, yeah. IUL usually has lower caps, but also at the same time, IUL you can actually go down because it's tied to the stock market, right? So if you're depending on that cash,
IUL, I'm like an expert at IUL too. IUL is not tied to the stock market; it's actually tied to a general account of the insurance company. If you Google it, do enough research, but the insurance company will give you a rate of return tied to the index you choose. Generally, people pick the S&P 500. But in order for you to have the rider for them to pay that amount, guess what? You have to pay fees and expenses. IULs I've seen, just do analysis, is over 3.5%, which is even more expensive than having a managed investment account. All right. So IUL, their fees are very high, in my humble opinion.
So the reason I did it was just the idea that if the market is falling, then I don't want the cash value to fall, because if I end up, instead of say having 100, and now I have 500,000, I can make cash purchases of real estate very quickly, right? And so I buy the property and then I refinance out after I purchase. It takes me 6 months and I just pay off the loan that I took out. The interest rate goes back towards the value of my cash balance, though. So that's the nice part, because I'm not paying the bank. The interest rate just goes to pay myself, right? So am I correct?
Correct.
Does it affect your DTI though? That actually, I'm not sure about that, Rick. Does it?
No debt to income ratio, and I'll tell you exactly why. Because what's the risk of the bank? Very little, because they are collateralizing your life insurance. So I'll show you a real example for all of you. Are you able to see my screen? So this is my policy. So you'll see here statement date as of July. I have a current interest rate of 4.3%. It's a loan amount of 960,000. What is my total amount to? Nothing, because I haven't used my loan yet. So I have a 960,000, 4.3%, no closing cost. This is available, but this is collateralized against my I have like 1.1 million in my cash value whole life. So I have this strategy too. But you're wondering, Rick, how come you didn't borrow yet? Because I haven't needed to borrow. And this is just my insurance. You guys, once again, I'm not an insurance agent. I'm not even a financial advisor. I'm a wealth management advisor. If you read that Forbes article, based on how much assets we manage, we're actually one of the top tiers in the country. But so here's how you design the best plan. Use your life insurance, depending on the type you have. I collateralize 95%. And if you work with a wealth management advisor, your non-qualified, which is not your retirement account, which is generally your individual or your joint accounts, that's called brokerage, or depending on the type of relationship you have with your advisor, you could generally collateralize up to 50% margin. So for us, depending on account size, we can go 50, 60, even 65. So we had a client that rolled over $5 million from another institution. That $5 million, which the other institution, and I can't disclose their name, didn't offer them a leverage ability. So once the $5 million came here, we were able to give them a $3 million credit line at prime. So the $5 million can stay invested in the market, and they could get a checkbook for $3 million and buy real estate like some of you. But they also have life insurance with us. So if their life insurance policy had over $1 million in cash value, guess what? They'll get a $950,000 credit line there. So think about all the liquidity. Their life insurance has $1 million that's guaranteed to grow. Their investment $5 million can go up and go down, obviously, depending on what they're investing in. But they got $3 million, 50, 60% of their non-retirement accounts leverage. They got $900,000 of their cash value insurance simply to buy real estate. And for many of you, here's how I buy real estate. I'm waiting for interest rates to rise to the maximum peak. Like, Rick, that's terrible. We're not a fan of you anymore, and that's okay. I'll tell you why. Because I don't borrow money from the bank. I do cash deals. So let's just say Nelson sees a real estate property for $1 million, and Nelson says, I'll give you offer at $1 million. I just go, oh, it's $1 million. I'm going to give you here, 960 grand. If I'll do a cash deal, I'll close it within 1 week. I actually could wire you the money and write you the check now. If you were to seller, you could get $1 million, but you might wait 2-3 months, depending on what state you are for closing, or you could close within 1 week for 960. Which one you think sellers would pick? Generally, if you do cash deals, the average, this discount, and Nelson and Annie could teach you this more than me, is probably 5 to 10% depending on the liquidity, right?
Oh, you could take a lot more discount than 5-10%.
Oh, good. Hey, Nelson, that's why I just joined your Facebook group, because I didn't even know that. Annie told me yesterday. So for one of the members, that is exactly not what I recommend. Okay, so what he remembers, and we're just all having fun. We're a closed Facebook group, we're a community, we're sharing ideas, just like some of you can learn from. The idea of learning, if you think you know it all, you'll never learn. The enemy of learning is thinking you know all, so cumulative. Someone just said, so we can set this up and be a hard money lender. I do not recommend that. Do not set these up to be hard money lenders. Then I'm going to never teach you guys any of this stuff again, because hard money lending is really high risk. My world, a client came to me and says, hey, Rick, I want to be a hard money lender. I said, I don't advise you to be a hard money lender because of the risk involved. But that's just it. But whatever you do, your cash value is up to you. But the purpose of this is using the cash value to possibly buy real estate, burr it, refinance it back out, pay back a policy, and then rinse and repeat, right? So that's all.
Yep. Jade mentioned, I believe we have a traditional whole life policy. Should we surrender them, or is there a way 1035 into an infinite banking whole life policy?
Who said that, Jay?
Jade.
Jade, super smart. Yes. Just like 1031 exchanges you could do for real estate, 1035 exchange you could do for life insurance and annuities. I'm not suggesting any of it because I really don't know your background. I don't know if you bought the traditional one or the overfunded cash value one, but definitely speak to your insurance agent or financial advisor. That's it. But I don't want you to be, so the last thing I want is after this session, everyone starts canceling the term, everyone starts canceling universal life, everyone starts canceling traditional whole life, everyone starts becoming a hard money lender. That is not the point of this session. It's about learning, but it depends on your unique scenario. So do not cancel it. I have traditional whole life. Traditional whole life is amazing if you, in my humble opinion, have debt or you have dependents and you're focused on death benefits. Traditional whole life focuses on the growth of death benefit. The overfunded cash value that I just showed you, similar to R. Nelson Nash's infinite banking concept, is focused on cash value. So these policies are super unique and flexible, not like how the media portrays it. If you really understand this, like I spent 15 years, I have had over 20,000 client meetings. Every year, because of my licenses, many of you are either physicians, either in finance. So for all of us to have licenses, you guys have to all take continuing education. I'm sure you know about that. So every year I have to spend over 100 hours of learning and continuing education. So the biggest advice I tell you is do not cancel it, because these policies, how you design it is dependent on how you need it. So you might have a policy that's more focused on death benefit, but review it, have your insurance agent or advisor review it. And I normally don't tell people to come let me review it because this is not for me selfishly, it's for you selflessly. But you could give it to Nelson to give it to anyone else or whatever the case is. But please don't cancel your policy just because I taught you this today.
Matt Wu asked, what is the bank loan rate that Nelson can get on his loan for 95% of his value? Easy. Look up the prime lending rate right now and then just add 1%. That's why I would have to pay if I got and collateralized the value instead of with the life insurance company. I went to like a normal bank. They would just do the prime value instead of adding the 1%. The difference is they might charge origination fee, and that the bank might end up no origination fee. Sorry, but
no
origination
fee, no closing costs, nothing. In fact, if you have less than 250,000, they charge you prime. If you have more than 250,000, it might give you prime minus 0.5. If you have more than like 500,000 or a million, what is prime right now? 5.5. What is mine?
4.5. 4.3%. Yeah.
4.3.
Yeah.
Because I have almost $1 million in mine. And this is an outdated payment. So over time, as it grows, my rates go down.
Yeah. Annie Lou asks, do we have policies that require full health check? Do these policies require full health check, or is it just something we sign up for? Yeah, you do need to do a full health check. Someone came by the house and actually like tested my blood and stuff. So what kind of underwriting is required?
You do require underwriting. However, because I was a managing director at 25, so I train advisors around the country, so I can tell you more. Generally, depending on the amount you apply for. So if you apply for less than 100,000, no medical, just medical questions. But if you apply for a certain limit and higher, then you have to do blood and urine. And then if you're like me, you apply for more than 5 million, they do an EKG. So depending on the insurance company, the requirements are a little different. So yes.
And he asks, what type of underwriting is required to get the bank loan against the cash value, aka such as a credit check, tax filing, or income?
Yep. So because I went through the same process myself, it generally takes 4 to 5 weeks, depending on how busy they are. Due to COVID, they've been busier, right, and rising rates. But they just look at your debt to income ratio. They look at your credit check. I would say in my career, I've never had a client get declined. I hope it's not you, but I've never had a client decline. Because if you think about it, if you have 100,000 in cash value, and I go to the bank and I say, hey, I want to get 95% lending. They're saying 95,000. What is the risk to the bank? In my humble opinion, slim to none. Why? Because they now become a co-owner of your policy because you're collateralizing it. And they said, well, I have access to 100,000. Rick, here's 95 grand. Then when I borrow the 95 grand, I have to pay IO interest, right? Let's say the interest is 5%. I have to pay 5,000 a year, $400 a month. If I miss 1 month, they'll give me a warning. I miss 2 months, they're going to send me a letter and say, hey, you're at risk of us surrendering your policy that we have access to, which has 100,000. And if you don't pay the 3rd month, we're going to surrender and they're going to get their money back. So therefore, I just lose my life insurance. So the risk to a bank when it comes to these underwriting is very minimal because you're collateralizing real asset and they're only lending you 95. And this can't go backwards, only going to grow. So therefore, the banks have less risk.
Can you write off life insurance premiums as an expense?
The general rule of thumb is no, but it depends, is my answer. The general rule of thumb is no, but it depends. If you Google the IRS tax code, life insurance is not meant to be tax deductible or written off. However, depending on what type of policy and how you structure it. So I have clients that depending on the type of policy, they do tax deducted through their business and they pick up in the form of an income on their personal side. I don't want to go into those details because many of you that are W-2 income earners do not qualify for that strategy. But if you're 1099 or you're self-employed, then that strategy may work for you.
Can you start a new policy after one policy is fully funded for 7 years to work around that case?
I have 17 policies. So the answer is yes.
Okay, John.
Right? You know what's the best question Nelson asked me, which is actually a question that the smartest people we work with ask me? Rick, before I decide to work with you, what do you have? Show me. And I showed him my whole family. And he was like, holy crap, why do you have 17 policies? I was like, I don't know. When I was 21 years old, I thought $300 a month was a lot of money. That's all I could afford. And who knows, today, after 15 years, I'm putting almost 175,000 a year, right? So when I started, I was doing $300 a month, right? And over the years, I just upscale it. So therefore my coverage changes.
Johnson asked, do you need a physical/lab work to purchase? Yeah, you need to be checked out. Jason asked, Rick, can you touch on any government policy risks where these policies could be taxed that are at least coming up soon? I know IRAs, we had a scare last year, so.
Yeah. So one thing that I would share with you is there's a lot of companies and financial institutions that do go to Washington and fight for these not being taxed. As of right now, these are still tax deferred, which are all income tax free. However, yes, Congress has proposed taxation of life insurance. If they're proposing that because they want billions of dollars from it, that means they see a big disadvantage to them and an advantage to the consumer. As of right now, because life insurance has also in my humble opinion, a moral and social ethic type of code, right? Imagine you start taxing my life insurance. It's kind of going to make people feel like it's less important to buy life insurance. And guess what? As people, if I had no life insurance and I passed away, my wife and kids would probably be bankrupt, broke. We'll have all our properties foreclosed. And guess what? They'll probably go on Medicaid. And great, they'll apply for government benefits and food stamps. So I don't know. So the government understands that if they do this, does it promote the purchase of insurance or not? So life insurance has in my opinion, a moral social ethic code, and that's why it's there's a lot of tax benefit.
All right, and with that, we are wrapped up for questions. That was a marathon run. We dipped below slightly half of the original attendee list because we went a little longer than expected, but hopefully that educated everyone on what we needed. Thank you again, Rick, so much for coming. And I really appreciate you giving the rundown and then asking all the questions individually and sharing your life story. So with that being said, if you're interested in the question in pursuing this further, how do people contact you, Rick?
I don't like to do self-promotion. If you want my contact information, just ask Nelson and Annie. That's it. You can Google me. But yes, and if you do reach out to us, just do me a big favor, because we do only work with credit investors or private clients that are referred in. If you do email us and find our contact info, please just mention in the subject, I saw you through Sayre's Facebook. So that's how we know where you're from, and there is no consultation cost. It's waived. So that's it.
Lovely. Thank you guys so much. Have a good rest of your night. And yeah, thank you.
And just a little bit, I hope to be at your event next year, Nelson and Annie.
Yes,
Sorry I couldn't make it this
absolutely.
year. It's a wedding event, but next year I'll be there live wherever you guys have it.
Yes,
That means I'll need to get
SareCon,
more bodyguards to protect Rick.
SareCon 2023. Well, I mean, the bounce doesn't go to any of us if he dies, but his kids are going to be very happy. So
I hope not.
not in the.
I hope I'm worth more alive than dead, but you're absolutely right. Yeah. Yes.
All right. Thanks again, everyone. Have a good night.
Thank you.
Take care.
Bye.
Be well. Bye-bye.